Permit, and this is Breaking the Mould with Investment Director Russ Mould. Russ, it's a new year. How are you doing?
Happy New Year to you, Clara.
Oh, Happy New Year to you
Pleasure.
as well. How are you?
I'm very well, thank you. Yeah, not bad at all. As you can see, full of beans.
Okay, Russ, full of beans, but what is the fuss?
Okay, well, I think you're going to have a couple of things that are going to really make the fuss. Christmas has been and gone. The market's still digesting its impact in terms of what it means for trading for everybody, and particularly for the retailers in 2015. So I reckon the fuss in the next week is going to be caused by a trading statement from online fashion king ASOS, an update from grocery giant Morrisons, and also the UK's latest inflation figures. All three, 13th of January.
Oh, so we've got something to look forward
have.
to. So let's start with, as seen on screen as it used to be known,
Good
ASOS.
knowledge, like it, yeah, very smart. Yeah, to be honest with you, ASOS will probably be one of those companies that's looking to think 2014. We'll park that one. One to forget. 3 profit warnings coughed up, and the stock took an absolute thumping as the chart behind us makes only too clear, straight down like that. Now, boss Nick Robinson has blamed currency movements, a fire at a warehouse in Barnsley, my mother county, and also investment in both IT and price cuts, and that's all combined to make a bit of a perfect storm of a year, really. Now, he also warned that for the year coming towards August, he's going to make around 45 million quid, still a good effort. That compares to 47 in 2014 and 55 million the year before.
So what should we be looking for from the Christmas season?
Yeah, I think there are 3 things you need to be looking for here. The rate of growth in the UK, the rate of growth internationally, and any commentary on margin and guidance there. Because let's face it, ASOS is still growing really quickly, it's just the rate of growth that it's been achieving relative to market expectations. Now, a first quarter update released on the 9th of December showed UK sales still up 24%, international down 2%, now that was a big bugbear, and also 170 basis point or 1.7% fall in gross margin. Now, the big question the investors need to ask themselves now is whether the short-term pain caused by that spending is worth it in terms of long-term gain. And if so, whether a price-earnings ratio of nearly 60 is justifiable, and that's even after the share price has gone from 70 quid to 25.
Well, I thought those share prices would have shot up because I spent a lot of money with them over Christmas.
Nothing would shock me, Clara.
So that's one disaster of 2014 dealt with. Should we move on to Morrisons?
Morrisons, yeah, fascinating stock. Just before Christmas, I spoke to 2 really smart, well-respected, strongly performing fund managers. One said he was buying the stock because he thinks the dividend's safe and it's cheap. One said he wouldn't touch it with a 10-foot pole. It's behind inconvenience, it's behind, it's online, and frankly would barely touch it at any price given the strategic weaknesses that still confront the company.
So it's a bit of a toss-up between the two at the moment.
It is, right? That's what makes a market, right? People have got views one way or the other. And the value hunters at the end of the year were just starting to get the better of it. The shares popped up a little bit. That momentum's now stopped. Sainsbury's fairly modest trading statement didn't help there. And in the end, people are now looking at whether this chart, again, another straight downer, will start to turn around or not. Now, the shares were hit by a string of awful trading updates, so the statement on the 13th needs to show some stabilisation in trading, really. A year ago, the FTSE 100 firm revealed a 7.1% drop in like-for-like sales, including fuel, and a 5.6% slide excluding petrol. Now, those numbers got worse as the year went on, so you actually end up with an 8% and 6.3% drop in those figures. So Boss Dalton Phillips needs to unveil something better than that to help convince the market his 3-year turnaround plan's working, the dividend is safe, and that there is value potentially can emerge.
Okay, should we finish off with a little bit of macro?
A little bit of Bank of England, a little bit of inflation, a little bit of Bank of England. Yeah, we've got the UK's inflation numbers. Obviously, the benchmark is what they were in the previous month. So the CPI, Consumer Price Index, that was up 1%. RPI, Retail Price Index, was up 2%. HPI, House Price Index, up 10.4%. Now, the collapse in oil and commodity prices is probably going to lead to a slide in CPI and RPI, and there's also some evidence of a cooling in house prices still as well. Now, in some, inflation's going lower. This is disinflation, not deflation, and it leaves inflation a long way from the Bank of England's 2% target. That means Governor Mark Carney probably isn't going to dash to raise interest rates. Now, the market's busily pushing out its forecast for the first increase to even early 2016 now, from late 2015. Even if Carney's still talking tough, I think the market's now convinced he's unlikely to act, certainly before the May general election.
Okay, thank you, Russ.
Pleasure.
Thanks for joining us. We'll see you in a couple of weeks' time. Until then, take care and goodbye.